Welcome. Today's video is again on adjusting entries, and the subject today will be depreciation. Depreciation is probably the hardest of the adjusting entries because there's so many new things to learn versus some of the others which you've had experience in. So let's look at some of a couple questions and then an example. First, the question I have: what does depreciation measure? It measures the loss of usefulness of a fixed asset to its owner. It measures the loss of usefulness of a fixed asset to its owner. So let's say the computer that this video was made on was purchased for, say, $5,000. It lasts 5 years. And this computer is 1 year old. Then I have lost usefulness of $1,000. 5,000 divided by 5. I have 4 more years of good life on this computer. So that's what it's telling me. It measures a loss of usefulness. Is depreciation a measure of market value? No. It measures the loss of usefulness to the owner. Maybe the computer might be worth $10,000 or $2,000. Market value is not determined by the amount of depreciation. Only the loss of usefulness of the in dollars to the owner of the asset is what is measured. What kind of an account is accumulated depreciation? It is a contra asset account. What does contra mean? It means that as the asset goes up, a contra asset subtracts from its value. So if I have a computer that's 5,000 and I've lost 1,000 in depreciation, then 5,000 minus 1,000 will give me what is known as book value, or $4,000. After 2 years, that'd be 5,000 minus 2,000, or book value would be 3,000. So accumulated depreciation goes up over time as the asset declines in usefulness to the owner. So it is a contra asset. Its total is the amount of the loss of the usefulness to the owner. So again, if my computer is 5 years old, I'll have a computer of 5,000 less accumulated depreciation of 5,000. So the value, future value to me of that computer is 0. And what does that mean? It means I need a new computer, right? Okay. Note, land is not depreciated. Land is assumed to be there, even if it's underwater, changes shape, or whatever. But land is not depreciated. Fixed assets that are depreciated include buildings, equipment, machinery, land improvements, which would be like a parking lot, and so on. So we'll see that in later chapters. Example. On January 1st, year 1, we purchased a $45,000 5-year life car with an estimated salvage value of $5,000. Now, what is salvage value? Salvage value represents what the crushed up value of the car will be at the end of 5 years. So the metal, the tires, the radio, that type of stuff. How much you can get out of that car at the end of 5 years if you were to take it to a salvage yard. So to depreciate, we need a formula. The formula I've given you is the straight line depreciation method. Now, the MBA 212 will look at other methods. Don't worry about other methods at this time. Just try and concentrate on this. Pretty simple. It's cost minus salvage value, so 45,000 minus 5, divided by life, which is 5 years in this case, or $8,000 per year. We never depreciate below salvage because that's what we're going to get when we crush the car at the end of its useful life and sell all the good parts. So in this case, that'd be $8,000 per year. And so on December 31st, since it's been a full year, we debit depreciation expense, income statement account, and credit accumulated depreciation, balance sheet account, contra asset, $8,000. So on my income statement, of course, I'll have depreciation expense. On the balance sheet, I will have auto valued at $45,000. The auto is always recorded at its historical cost. So at any time during the life of the auto, I can see what the value of that auto is. So if this was 45 less 40, which would have a book value of 5,000 at the end of the life of the automobile, I could see what the auto originally cost. Less the accumulated depreciation for 8,000 gives me a book value of 37. 45 minus 8 is 37. At the end of 2 years, it would be 45 minus 16, and that's 29,000, and so on. So the accumulated depreciation will go up by 8,000 every full year. So it'll be 8,000 year 1, 16,000 year 2, 24,000 year 3, and so on. You must remember all the information on this page. This is important, and it will take time to learn. There is no way around it. Half of or a good portion of the test from the chapter that deals with adjusting entries will be on depreciation. So please do study this in depth. Again, it measures the loss of the usefulness of the fixed asset to its owner. It does not measure market value. Accumulated depreciation is a contra asset account. Land is not depreciated. Remember that fact. Remember the formula. Now in the test you are given generally some notes, so be sure to put that formula on the test. Cost minus salvage divided by life. The adjusting entry is to debit depreciation expense and credit accumulated depreciation. And our book value calculation would be auto at the original historical cost minus the accumulated depreciation, and it gives me the book value. Book value is not market value. That auto may sell for $60,000 now, so do remember that. Take care and see you on the next video.